Hello, good afternoon, everyone. Welcome back to the channel. So, from my couch to your screen, I am coming to you today with a very simple and basic video, investing for beginners. So, all of us on here, in fact, the majority of us started from scratch. I would say all of us. And a lot of viewers on here are obviously looking about how to invest from scratch as a total beginner. And a lot of what my channel focuses on are very advanced concepts that may be a little bit advanced for the majority of people. So I figured today let's do our simplest, most basic video that we've done. So as I read some notes to you all here, I'm going to use some screenshots, but let me just get going here and tell you all the basics of investing for beginners. So let me ask you all, if you've never invested before, where does your money that you have now sit? Just in a bank account, probably. And if you think about it, if it's just sitting in a bank account, it's probably just dying, seriously, because of inflation. If your money isn't growing at least 3 to 4% a year, you're actually losing purchasing power. This is something I emphasize over and over again on this channel. So today, I'm going to try to provide to you the ultimate guide to investing for beginners. No jargon, no high-risk gambling, just simple, actionable steps to make your money work harder for you. By the end of this video, you should know exactly how to start, even with just $50 or $100. Let's get into it. And as a side note, this is not financial advice. This is for edutainment purposes only. Little word I conjugated, edutainment. It's the nexus of entertainment and education. So we're going to talk about why savings isn't enough, and it never will be, because at the rates of inflation that we've seen over the past several years dwarf what you're paid in savings accounts. The classic philosophy that your grandparents might have told you, or even your parents in some cases, they might have talked about just putting money into a savings account or into CDs, and that was like their only blueprint. And in many cases, they probably never even touched the stock market. Well, the world is different, today's world. So we have to invest. If we want to beat inflation and have actual wealth, we have to invest. So this is not our grandparents or even our parents' world. And I preach this over and over again, and I can't simplify this enough. So savings is not enough. Savings is for emergencies. Investing is for wealth. Inflation is like a hidden tax. If you want to retire or just live better in the future, you must invest. We're going to talk about the three C's: consistency, commitment, and compounding. Compounding is so important. One of the first videos I ever did on this channel focused on compound interest. I call it the eighth wonder of the world. I'm not the first one to coin that phrase. Many others have referred to it as that. So we're going to talk about the three C's and prerequisites. Before you buy anything, you need to understand these three C's. Consistency involves regularly adding money. Commitment involves holding for the long term, which is at least 5+ years. And then compounding is letting the magic happen, letting your interest earn interest. Interest on top of interest is a true wonder to behold. It is truly magic for the beholder. So before you invest, do not invest until you've done at least four of these four things. Number one, you want to pay off high interest debt, which includes credit cards and the like. Credit cards, high interest loans, so on and so forth. No investment return is going to beat that return that you can get by paying off that debt. If the debt is over 20%, in some cases 30%, no return you can get in the market is going to beat what that interest on the debt is. That is by far your best return. I know Dave Ramsey says this. Coach is saying this also. Number two, build an emergency fund, which is 3 to 6 months of expenses in cash. Number three, define your goals. Is this for retirement, a 30-year horizon, or a house in 5 years? And in many cases, a lot of us out there, and there's no shame in this at all, a lot of us are late to the retirement game. And that's fine. That happens to a lot of us. So a 30-year horizon might not be for you. You might be looking at a 20, 15, or even a 10-year horizon. In that case, we do have more advanced strategies we can pursue that can help you accelerate that goal. But for now, we're going to focus on for beginners. So let me do this here. Hold on a second. Okay, so yeah, so like I said, your goal horizon is very important. And understanding your risk tolerance. Can you watch your portfolio go down 10% in a month without panic selling? Now let's get into the meat and potatoes of it, where to invest, accounts, and tax advantages. I had a graphic I wanted to share with you all. Here we go. Okay. So, what I want to share with you all about time horizon. Welcome to commenters we have on here. Someone's washing dishes, someone's plugging STRC, someone says it's pouring. It's actually raining over here too. Sending, oh, awesome. Yeah, thank you. All right, we got good comments in the comments section here. Thank you. Okay, so let me share this graphic here while we ruminate over how to invest for beginners. So, do it early. Cannot emphasize this enough, because if you start, and this may make some of you feel bad that are like older, but if you start in your 20s, you see the far left side of the graphic, it's easy to get to be a millionaire with compound interest, just with a basic investing strategy. If you wait till you're 25, according to this graphic, you're looking at 730,000. If you wait till you're 30, you're looking at 487,000. 35, you're looking at 322, and then by 40, you're 209,000. So, thankfully, since you all have found me, we have more advanced strategies that can make up for the time horizon gap. But in terms of purely investing for beginners, this is the core concept that I'm trying to emphasize to you all here. The earlier, the better. So, with that being said, let's see here. Where are we? Okay, so Roth IRAs are tremendous versus taxable brokerage accounts. So, where do you actually buy stocks? That's one of the most common questions. You need a brokerage account to start. You can start anywhere from Fidelity to E-Trade to Robinhood to, there's even like eToro. There's Vanguard. There's Charles Schwab, to name a few. But you need to open an account with one of those. Think of it as a specialized shopping cart. For retirement, if you're in the US, I would strongly encourage a Roth IRA. Money goes in after tax, but it's never taxed again, even when you withdraw it. Look up Peter Thiel. Look up how he turned 2,000 into millions of dollars. It's insane. The truly smart, genius level people out there that know what they're doing, they can use these tax advantage accounts to their maximum potential. Um, and I was just reading about that the other day. Not only Peter Thiel, but I think even I'm actually watching another presentation that I may do a video on about how even Mitt Romney turned a small investment into hundreds of millions of dollars. So the well-connected, the rich, well, I should say the ones that came up well-connected and very smart people can absolutely maximize this. But this is for the general audience. You know, I get it. Not everybody's going to do that. For general investing, a standard taxable brokerage account. For retirement, a Roth IRA. Now, 401ks, we're getting a little advanced here. We're deviating from the script, so to speak. But for 401ks, that is what's called a tax deferred account, meaning that if you make over a six-figure salary, you're actually deferring your tax until you retire. A lot of people complain about having RMDs and all that. They think, well, I've already paid tax on that. Not necessarily. That's part of the contract you signed up for. By the time you get older and you're withdrawing money from your retirement accounts, and in terms of 401k, because it's tax deferred, you had your higher levels of your salary. Presumably, if you make 100,000 and the taxable, or excuse me, the maximum contribution you can make to a 401k is 24,000, you're shaving off your taxable income at the time that would be at a higher tax bracket, and you're deferring it to retirement when presumably you're at a lower tax bracket. And then you can take your RMD and hopefully maybe only be at a 15 or 20% tax rate. Open accounts at reputable places like Vanguard, Fidelity, or Schwab. They have low fees, which is crucial for beginners. And for those of you just starting, you all are very lucky because they've really democratized trading and investing. Because back in the day, we used to have to pay $20 commissions, and then they dropped down to $10 or $5 commissions for just making trades. And eventually, once Robinhood and some other smaller brokers came onto the scene, which of course they're getting a lot bigger now, but they really democratized investing so that it's essentially all free unless you trade options, which that's another story. I do a lot of options videos. You all may notice my title of my channel is called Live on Dividends and Options Now. So I obviously do a lot of advanced investing strategies, but this video is specifically for beginner investors. So what to buy, stocks versus index funds. Now, what's an index fund? An index fund is basically a basket of goods. Take the S&P 500, take the NASDAQ, take the Russell 2000. Those are indexes. So the S&P 500 is essentially I don't know where I got the number three, the 500 largest companies in the United States. Companies get rotated in and out of there. They have to make certain criteria to stay in there. Same with the NASDAQ, same with the NASDAQ 100. They meet certain criteria to be in there. That's considered an index. You have less risk of what's called single stock risk when you're diversified in an index fund. On the other hand, people like Warren Buffett will tell you diversification is bullshit, but you can get to where you own way too many stocks. I try to keep it to the lesser amount of stocks and the more concentration in certain stocks, but that's when you get more advanced and know what you're doing. So think of an index fund as a basket of fruit versus a single apple being an individual stock. So you have your account. Now what? You can buy individual stocks, but that's high risk, like throwing a dart at a board, which even a monkey sometimes is successful at throwing darts at a dartboard. For beginners, I highly recommend index funds or ETFs, which stand for exchange traded funds, not mutual funds. That's an entirely different video, which I've done before. Mutual funds essentially rip you off, especially when you have them with a financial advisor. Ask anyone that's been with a financial advisor, they know. And I could talk till the cows come home about, what a rip off those things are. So an index fund allows you to buy a tiny piece of hundreds of companies all at once, like the S&P 500. This provides diversification. If one company fails, you don't lose everything, and there's constantly rebalancing and things like that. It's sort of a set it and forget it, which to a lot of you that appeals to. A lot of you don't want to think about money, which the irony, like I always say, how do you get good? How do you get to a point where you don't have to think about money? You have to get good at thinking about money. That's kind of the irony of it. Let's see here. We've got a good evening from Wolf5047. Welcome. I try to engage with the audience and read the comments as I go. And please, for you all that are on, please smash that like button. Greatly helps the algorithm. It's a win-win. Okay. With that being said, let's continue. So, where are we? Okay, so we're talking about ETFs. So set it and forget it appeals to a lot of you, requires little time and effort to build long-term wealth. Now we're going to talk about dollar cost averaging. This is a very key strategy. So what this means, obviously, especially as we see recently, the market is very volatile. The market is up and down. There's a lot of fluctuation within the market. How do you mitigate this? Well, there's a mitigating strategy called dollar cost averaging, which means you pump fixed amounts of dollars into the market no matter what. So think of conceptually, think of $100 every month going into the market, regardless of whether it's up or down. So you're worried about investing when the market is high. That's why you dollar cost average. Instead of investing 1,000 at once, you invest 100 every month. And remember the saying, time in the market beats timing the market. You can try to time the market. There's very, very small odds that you'll succeed. But overall, people that try to time the market don't succeed. So as a beginner, you want to dollar cost average into the market. So what happens when the market's up? You end up buying fewer shares because the share price is higher, which means less shares bought with the dollars. When the market is down, you buy more shares, the shares become cheaper, and you buy more shares because the share price is cheaper, so that $100 goes further. It removes emotion and timing risk. So to conclude, there's some very basic and key steps that we've talked about. You want to clear your debts first, build an emergency fund. That's absolutely key. Open a low-cost brokerage account, Roth IRA if possible. Buy diversified index funds or ETFs. Automate your investing with dollar cost averaging. And in full transparency, the best time to start was yesterday. Well, actually before all this volatility this week, but best time to start is as soon as possible. The second best time is today. So if you found this helpful, please smash that like button and subscribe for more beginner-friendly finance tips. Let me know in the comments, what are you investing for? Let me know your favorite stocks. Let me know what you think about this, and we will see you in the next video. Now, a few more things here. Like I said, not a financial advisor, but I am a financial coach. So again, I thank you all, and we will see you all in the next one. Take care. Bye.